recording. Some of this may be repetitive, but just in case, we'll just go ahead and repeat the same things that we said before, so that we'll be able to remember them better. All right. Are there any questions before we get started? No questions? All right. So our first exercise, we are required to complete the table to calculate the price of the $1.8 million bond issue under each of the following independent assumptions. They were different. I think they were listing like 5 of them, different scenarios. I just picked one to do the one that we have semi-annual interest. The semi-annual is a bit more challenging than annual, of course, but also review the annual, okay? So in this regard, what's the first step in calculating our issue price? So we said we have 2 steps when calculating issue price. What is the first step of a bond? Issue price of a bond. The present value, okay, of the principal amount. So in this regard, what is our principal amount? $1.8 million, right? 1.8 million. All right. And we can go to the table. Now, I is equal to what? So the bonds pay interest semi-annually. So in terms of our interest rate, we are looking at 5%. We're looking at the market rate, okay? To determine the issue price, we're looking at the market rate, all right? And what is N equal to? So what are the number of periods? $16. Okay, so 8 multiplied by 2 equals 16. Okay, so we got that. So we can go to our present value of one table, look under the 5%. I can't see very well because it's very small. I should make it smaller, bigger. That makes sense. Hey. All right, and then we want n equals to 16, so I have to go to row 16. Okay, row 16 is right here. And so my present value factor is 458, 11.458. So I'm going to take the 1.8 million and multiply by 0.45811. And that equals 824,598, hopefully. All right, so we got that done, and we need to move on to the second part. So what's the second part? The present value of the interest, right? Because the interest is paid at fixed intervals, okay, at the end of the period. Then we're using present value of an ordinary annuity to calculate that. But before we calculate the present value, we got to calculate the amount of interest. So how do we do that? We do that like any other calculation that we've done for interest ever since the beginning of time. All right. So we're going to multiply by the interest, the stated rate, right, which is in accordance to the contract. And so that's going to be 12%, but because it's semi-annual, it will be the 6%. So 1.8 multiplied by 6% is 108, right? So we need to find the present value of an ordinary annuity of 108. So the same facts applied, except that instead of going to the present value of one table, I'm going to the present value of an ordinary annuity table to column 5 and n equals 16. So 5 and n equals 16. So my factor is this 10.837777. Okay, so now I have the present value of the ordinary annuity interest payments, and this will give me the issue price of the bond. So if I'm the corporation, I'm issuing these bonds, then I'm gonna sell these bonds at the 1,995,077. All right, so that's the issue price. So just for kicks, what would be the journal entry for the issuance of the bond? They didn't give us a date. I guess we can just put January. And the question did not ask for this. This is just, let's see where we at. So we are going to debit cash, correct? Because the whole purpose of issuing the bonds was to get cash, right? And I'm going to credit bonds payable for what amount? $1.8, correct. That's the face value of the bond. Bonds payable is always credited for the face value of the amount of the bonds. And I have a difference. Oops, sorry. Wait a minute. Was this a premium? Oh yes, it is a premium. I'm sorry, because the bonds stated rate is 12% and it's greater than the market. So when the stated rate is greater than market, we're going to have a premium. So yes, we have a premium. So credit, Cody, very good. Premium on bonds payable for the difference, which is 195,077, if my math is right. Yay, we did it. All right, so that's that. Justin, okay. All right, so we have myriad solutions. Okay, so I'm gonna move on to an Excel spreadsheet that I have just so that we can kind of do this a bit more quickly and so we can cover all the problems that we have today. So let me share my screen. and go to the Excel spreadsheet. All right, so hopefully you guys can see this. If you don't, please let me know. You need to kind of shout it out because I'm in a different screen, as you can see. So I cannot read your comments. But I'm trying to. All right, there we go. Okay, so we have Myriad Solutions Inc. issued 12% bonds dated January 1st with a face amount of $420 million on January 1st, 2021 for $375,505, 452. The bonds mature on December 31st, 2030. For bonds of similar risk and maturity, the market yield is 14%. Okay, in this case, since the market rate is higher than the stated rate, then the bonds are issued at a discount. You don't have to calculate the issue price because it's already given. Okay, so you don't have to do this part. And then we're told that interest is paid semi-annually on June 30 and December 31st. All right. So we're asked for the net amount of the liability that they will report on the balance sheet on December 31st, 2021. So we need to amortize for the two payments so that we can have an ending balance for our bonds payable liability that will be reflected on the balance sheet. All right. So for the cash paid, what would be our formula? So if I was going to do a formula here for the cash paid by the corporation to the investors that purchase the bond, what would be our formula for this? And you're going to have to talk because I don't want to go back and forth between the two screens. So don't type, you need to talk. Hello, 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 hello. I can hear something. Guys?
Is it 420 million times 12%, which is the stated rate, divided by 2?
Yes, it is. Are you telling me or asking me?
I'm telling you.
Okay, all right. So it will be, yes, it will be. And so we said the day that we issue the bonds, there's not going to be, of course, any cash paid, but because the interest is due June 30 and December 31st. So in this case, so we have the 420, oh no, there's so many zeros, multiplied by the 6%. So this will be the payment, okay? And then we need a formula for the interest expense, right? So could someone else give me that formula? Remember we're using the effective interest method. So we need a formula for the interest expense.
Would it be carrying value times the...
Well, yeah, I guess for the beginning will be the issue price, but then after that will be the carrying value. Yes, you're correct.
Okay. And then the
Multiply.
rate would be 0.07 or 7%.
Right, the 14% divided by 2 because it's semi-annual, so very good. So we'll go ahead and put that here. So this is going to be our carrying value multiply by half of 14%. We'll carry that on here. And then we'll carry this here. And the amortization is the discount, right? The discount on bond payable amortization. So we're going to take this amount. And since it's a discount, it's going to be added to the carrying value. All right, so we are asked what would be the ending balance of our liability. So that is answered by, right, we need a balance for December 31st. So that's our balance that will be shown on the balance sheet under long-term liabilities, except for the 25,200,000. Actually, the long-term liability will be this less the 25,200,000. In essence, I mean, I don't know. They didn't really say to classify it as current or non-current. We're just told net liability, so that's the net liability. But if we were asked what would be the current and non-current portion of this liability, you have a payment that comes up. You have two payments actually within a year, and those two payments will be reflected as current and then the balance as non-current. But we weren't asked that. Okay, so what would be the amount related to the bonds that Myria would report in its income statement for the year ended December 31st, 2021? So how would you answer that question? And unfortunately, you do have to talk. We value the sound of your voice. So how do we answer number 2? Guys, let's hurry up so we can move on to the next one.
Is it asking for interest expense?
Right, so it will be the interest expense for 2021. So we only have two amounts to report. So the total, but I don't want to insert anything. The total of these two amounts, so I just want to put it in a different color so that we know that this will go to the income statement, right? So this is income statement. So it will be the total of these two amounts, all right, as interest expense. Number 3, what would be the amount related to the bonds that Myria would report in its statement of cash flows for the year ended December 31st, 2021? Well, first of all, if you recall, in the statement of cash flows, we have a financing, right? We have 3 different activities: operating, investing, and financing, all right? And so any amounts that are received or due from creditors and shareholders are reported in the financing section of the statement of cash flows. So would anything here apply to that section? And what would be the amount that would be reported there? This corporation received any amounts from creditors? Or did it pay off any debts? Hello? Hello? Okay, we're gonna spend the next hour. Anyone? It's okay if you have already participated. Any amounts were received from creditors?
Yes.
Yeah, yay!
Would it be the 375 million?
Yes, that's exactly the amount that was received from creditors. So amounts received from creditors and amount paid to creditors will be reported under financing, while the interest expense is reported under operating. Okay. Operating activities, that will be our interest, which was 52,000. I'm sorry, the cash paid, actually, not the interest expense, but the cash that we paid, because it's a statement of cash flows, will be under operating activities. Okay. All right. Any questions? No questions. I'm gonna stop sharing. And we're back. So moving on to the next one. I know we kind of did this in class, but I just want to review it one more time. On February 1st, 2021, Strauss Lombardi issued 9% bonds dated February 1st. This one has, is this one the one that has a twist? No, there was another one that had a bit of a twist. But okay, we'll leave it like this. This one, I think we have to accrue the interest, if I'm not mistaken. So they issued it on February 1st, 9% with a face amount of 780. The bonds sold for 713.83 and mature on January 31st, 2041. The market yield for bonds of similar risk and maturity was 10%. So our rate is lower than the market rate, therefore they will be issued at a discount. Interest is paid semi-annually on January 31st, January 31st and July 31st. They have a calendar fiscal year. Okay, so this is gonna be an accrual on December 31st because the actual payment is not due until January 31st. So I think we kind of illustrated this in class last time, but I just want to kind of cover it one more time just to make sure that we're all on the same page. Here, this one, again, we don't have to calculate the issue price. Issue price is already given. So all we have to do is the journal entry. So on 2/1/2021, you guys had already provided me with that journal entry, which is a debit to cash for the issue price. Okay, and a credit, sorry, we have a debit to discount too, but I'll do that later. A credit to bonds payable for 780,000. All right, so we have a discount, as we said, and the discount is for the difference. Okay, So we have on July 31st, we're going to do our first payment of the interest. I'm just going to do a quick calculation instead of doing our beloved table. So basically, we're going to take the 713,083 and excuse me, and multiply by 5%, right? And that should be 35. $35,654. Did I get the right amount?
Yes.
Could someone confirm for me really quick? So that's July 31st, 21. So much you agree?
Yes, I agree.
Thank you. So interest expense, 35,654. Credit cash. The cash, remember, is going to be 780,000 multiplied by 4.5%. Did someone concur? 35.
I concur.
Thank you. All right. And then we are going to credit our discount. Oops. For the difference. That is 1,554. Okay, so that is our entry. The difference, okay, so that means that the carrying value, and if you're confused by this, you're welcome to do the table that we just worked on for Myriad. You can use that same table, change numbers around, and apply it to this problem as well. I'm just kind of doing a quick and dirty calculation here. So plus the difference, which is 1,554. So my carrying value will be...
Now, Professor, the discount on bonds payable should be just 554.
554. Oh, where
Yeah.
did I get the...
It's an extra
Thank
1,000.
you.
No problem.
So we're going to take the 713,083 plus the 554 to figure out the new carrying value, which is anyone? $713,637. This will be
Yes.
the carrying value. Thank you. For December 31st, or as of actually January 022. Right? That's the carrying value. Okay, so we're gonna have to do the same calculations, except that there's a twist, because we actually, since the payment is not due until January 31st, we are going to have to do an adjusting entry to prorate the interest expense, because it's straddling two periods. And we're going to credit our interest payable. And then, of course, we're going to have our discount on bond payable as well. So that's an added complexity, right? So from July 31st through December 31st, we have how many months?
That would be 5 months.
Okay, we have 5 months. Tiffany agrees. All right. So we can calculate it for the 6 and then divide it by the 6 months and then multiply by 5 or 5, 6. We can do that. So we're going to take, okay, so for the interest expense, we're going to take our carrying value of 713,637 and multiply it by 5%. So that's the interest for the 6 month, right? 35,681.85. And we can divide it by 6. So that's 5,946, 947, and then multiply by 5. So I get 29,735. Yeah. So that's my prorated interest expense. All right, now I need to calculate the bond. So it was 35,100 for 6 months. So that's 5,850 per month multiplied by 5. It's 29,250. And then I just plug the difference there. All right, so there we go. And then for the entry on January 31st, '22, we're going to have, of course, a debit to interest payable. That's probably the easiest one. You want to get rid of that liability. And the credit to cash, we already know it's always a set amount. So we just need to start plugging differences in here. First of all, is the interest expense. I think we already said that for the full 6 months was 35,682. Then we can take that 35,682 and subtract the amount that we already expensed last period. So that should give us the remaining interest expense as applied to this period. I get 5,947. If I lost anybody, you can, watch again this recording. Okay, thank you, Donna, for verifying. Okay, and so now 29,250 plus 59,47 minus 35,100. I have 397. 397 or 197? You got just 97. Okay. Well, 97 was correct. The rest was wrong. Okay, all right. So there we go. Okay, so this is when we're straddling 2 years Okay, we have to accrue on December 31st, and then we also have to reflect the payment the following period. Questions? All right. This one is similar to what we just did, so I'm not going to work on this because we already did that. Oh, but this one is asking for different things, isn't it? Is asking for... Oh, okay. So the last two questions are pretty much like the previous examples that we gave, right? Where we are asking for the statement of cash flows. So in terms of the statement of cash flows, we said what goes into operating activities. Just no, you don't have to give me an amount. Just yeah, these are the cash outflows for interest payments. Okay, so it's not the interest expense per se that's showing on the income statement, but is the actual amount of cash outflows that we paid, right? The amounts that we paid. So in this case, since we only have one payment that falls in this period, then we will only have that payment. Do I have something else here? I have this and I don't have anything else. And we still have time. Okay, so let's do this one. Yay. All right. So we were given the face amount of the bonds, the issue price of the bonds. The stated rate is 10%. The market yield is 12%. Therefore, we are going to have a discount. We can see that by the difference between the face amount and the price. Interest is paid semi-annually on June 30 and December 31st. However, this company, okay, has a fiscal year end of September 30. That means that we're going to straddle two periods again, and we're going to have to accrue the interest just like we did with the previous example. All right. And then they have the same questions that they had before. What amount will be shown on the balance sheet? What amount will be shown on the income statement? And then what amounts will be shown on the statement of cash flows? This makes for an excellent exam question, don't you think? All right, so red alert, red alert. Okay, so now we start with the first entry made on January 1st, 2021, where we debit cash of 145 million, credit the bonds payable for 165, and the difference to the discount of 20 mil. All right. Well, at least they have well-rounded numbers. Okay, so that makes it a bit more understandable. Okay, our first payment is on June 30. Okay, so we're gonna have interest expense. I don't know what it is. I'm gonna have a credit to discount on bond payable. You should also pay attention to how a premium is recorded. Okay, I don't know why most of your exercises are discounts. That I found that a bit annoying. But just make sure, make sure that you also review. And I think that we did a premium in class. So make sure that you review the premium as well. And you think about how does the investor report these transactions. So that's chapter 12, okay? I think there was a question in Connect related to the investor, but I took that out and I gave you 4 points for that. Because we did the investor in chapter 12, we're grouping these 3 chapters together. So I don't think that we need to do that for this purpose. But just think about that also, okay? So in terms of our interest expense, we begin with the 145 million. This is semi-annual, so the rate will be 6%. Okay. So in this regard, my interest expense will be 8 million. These are huge numbers. 8 million. Okay. 8.7. That's my interest expense. And then the amount that I'm actually paying is based on the stated amount of the bond with this stated rate. So that's 250. 8,250,000. Okay, so I can do this entry now. Debit to interest expense for 8,700,000. Oops. We have a credit to bonds payable, 8,250,000. And then we have a credit to discount for the difference of 450. All right, thanks, Tiffany and Sheena. Okay, there we go. Did we put a date on this? We didn't. I thought I did. Okay, this is July 30. No, June 30. June 30. Okay, and now comes the problematic one. September 30, 2021. All right, so we have to accrue from June 30 through September 30. Okay, so if my math is correct, I believe we have 3 months, right? Because it makes it a little bit easier. Now we can take the interest expense divided by 2. We can take, and you guys didn't correct me here. It's supposed to be cash. Cash. Okay, this is supposed to be cash. All right. More coffee for me. All right, and so we are going to calculate our interest expense. So the carrying value of the bond will be the 145 million less, oh no, I'm sorry, plus 450,000. So this is a lot of zeros. 145, 1, 2, 3, 1, 2, 3, plus 450. So we have, and I promise on the exam not to have so many zeros. You know, that usually leads to confusion and mistakes. All right, so this is a new carrying value. And for the interest expense, we're going to take this carrying value, multiply by 6%, divided by 2, right? So basically, any objections? So I have 4,363,500. Okay. For cash is the 165 5 million. Oh, I'm sorry, is the 8,252,000. 8,250,000. I told you guys more coffee. And multiply by 5% divided by 2. So, no. Guys, what am I doing? What's wrong with me? Okay, cash is 8,250,000 divided by 2. 4,125,000. Thank you. All right. So now that we have the amounts, all we have to do is plug it into our journal entries. So interest expense of 4,363,500. I'm going to leave the discount out. In this case, we have interest payable because there's no cash paid of 4,125,000. And then we have a difference to discount on bond payable of 238,500. All right. Now, they didn't ask, but if they were to ask, and we have the payment on December 31st, 21, then we're going to have a debit to interest payable for 4,125,000, right? We will have cash of 8,250,000. And now we kind of have to fill in the blanks. We're going to have interest expense for the other half. So 4,363,500. And then we would have a discount on bond payable for the difference. And that difference would be $238, right? The other half. Okay. So that illustrates how we would accrue the interest on the bond. Okay. And now we can answer the question. So they asked us what would be the carrying value on September 30. So the carrying value of the bond will be the 145 mil plus 450 plus 238,500. And so that amount that we would report will be 145, 688, 500. Maybe someone can confirm that for me. So this answers number 1. For number 2, they're asking on the income statement. So for the income statement, we're looking at the interest expense for that period. Okay. So the addition of these two numbers will answer number 2. So number 2, 13,063,500. That's the total of our interest expense that will be reported on the income statement. And then we're looking at outflows of cash, okay? Outflows of cash. So cash of 8,250,000 is the only outflow of cash related to interest that's reported on under operating activities on the statement of cash flows. But we also have another section of the statement of cash flows that the bonds will also have an effect on, which is what section? Financing. Did we say financing? We didn't say financing, but Justin gave us the amount. Financing activities, and that amount is the 145 million. All right, so you have, this would be a plus, right? This would be an increase, and this would be a decrease. But yeah, I don't think that Connect is asking you to put plus and minus signs. But I'm just showing it the way that it would show on the statement of cash flows. Okay. So this makes for an excellent exam question. I like it because it kind of includes everything that there is to know about bonds. Okay. And this story right here has a twist. And the twist is that we're using, we're using the straight line method. And I know I have stressed the effective interest method because I think that if you know the effective interest method, straight line is very easy, okay? Because effective interest is very difficult. So we have 3 years ago, American Insulation Corporation issued 10%, 820,000 10-year bonds for 780. American Insulation exercises call privilege and retired the bonds for 810. The corporation uses a straight line method to determine interest. Okay, so and I am assuming that the interest is paid annually. I don't know if you guys are making the same assumption or not because they haven't told us otherwise. And so the discount on these bonds, we need to find that first because we need to figure out what is the carrying value of the bond. So that's 20, that's 40. Is it 40, the discount? Okay, so that happened 3 years ago. So basically, we would have, let's say they purchased it 3 years ago, 20, is that 2018, 3 years ago? Cash of 780, bonds payable of 820, and then a debit to discount for 40. Right? And we're saying that the discount is going to be amortized using straight line. So divided by 10, is that 4,000? And we have 3 years have passed. So multiply by 3 years is going to be 12,000. So this is the amortized amount of discount. So if we started with 40, this is our T account. This is our discount on bond payable. Remember that a debit increases this account and a credit decreases it. All right. So we started with 40,000. We decreased it with the amortization by 12,000. So now our ending balance at the end of the 3 years is 28, if my math is right. All right. So since we are selling these bonds, then we're going to have to zero out this account. So in figuring out the carrying value of our bonds, we take our face value of 820 less the unamortized amount of discount, in this case the 28. So I'm sorry, this should say face value actually. And this is the carrying value. So note that I'm subtracting the unamortized amount, not the amortized. Which I should be doing the opposite. Okay. Wake up. Okay, and calculating the carried amount, we take our 820,000 less the amortized amount of 12,000. No, I think I was doing it correctly. Sorry, guys. This is why I like to use a table. All right. So 820 minus the 28 is 792. And we sold the bonds for 810. 2 minus 810. So we had to pay more, okay? The cash that we paid, it's 810. We have to pay more for repurchasing or paying off the debt versus the amount that we had in our books by 18,000. So this amount that we had to pay on top of the amount that we had calculated in our books, our carrying value of the bond is a loss. Okay, this is a loss. And therefore, now in constructing our journal entry, so let's say that at the end of the 3 years, we sold the bond then we are going to get rid of the liability. First of all, we get rid of the liability. We get rid of any unamortized amount of the bond, which is the 28,000. And then we also record the cash that needs to be paid. And we also record the loss of 18,000 in this case. So remember, a loss is a debit, a gain is a credit. So if we, instead of 810, we paid 700,000, okay, to extinguish the bonds, to pay off this debt, then instead of a loss, we would have a gain. Okay, a gain. So you have to get the carrying value of the bond up to the date of sale and compare that to the cash that you need to pay to liquidate that debt. And that would be the amount of gain or loss that you have to realize. And then you also have to get rid of the bond. The liability should be a zero. Your discount or premium should be a zero. Okay? None of these accounts should remain on your balance sheet. So I think that pretty much covers the assignment